We're pleased to announce the introduction of Risk Reward add-on to our OFA toolset, and this video is an overview of the toolset and the features. The prior video on the settings covered all the main settings for this, so most of these have been covered. This add-on has been designed for both non-AlgoX users and also with benefits to AlgoX users in their pre-trade process and in the design and refinement of their algos. In order to efficiently work with the unfolding profiles, we've developed the risk reward menu to be as dynamic as possible to support the process of very quickly assessing any risk reward opportunities with offset adjustments and making adjustments to the risk, and also any risk reward ratios can also dynamically be adjusted from the menu without any need to go back into the OFA parameters. Before getting into the main features and benefits and to illustrate some examples, I'd just like to cover some background on this very important aspect of trading. With some of the context of risk that we present in this overview, it is hoped that and intended that you make this an habitual part of your trade analysis and trading to help you ensure consistency with the risk reward of each of your trades that are part of your edge. I've described here the edge as an edge is where you have identified a scenario that provides a higher probability of one outcome happening over another. I'd just like to read the first section of this paragraph, not all of it, just the first section on this background of risk reward. Anything can happen in the market, and the best way to address this is by keeping your convictions strong and keeping risk small. From reviewing the risk of ruin tables, which I'll take you to in a moment, you don't need to know exactly what is going to happen next in order to make money. I now understand I can be wrong more times than I am right and still make money. There being a random distribution between the winners and losers for any given set of variables that define my edge. One needs to account for the fact that your edge, which does have positive expectancy, can and will go on its periodic losing streaks. Every moment in the market is unique. And this allows one to understand that every trade you execute is unique and independent of one another, so therefore you must risk size every trade the same, as each trade has its own equal opportunity. So with this in mind, I'd just like to take you next to the risk of ruin tables, which is a small statistics map, just to cover an example of this. So we've provided this statistics map of risk sizing and risk of ruin to give you a foundation to reference in your risk reward setups and your win rates, just to give you an illustration of stacking the odds on your side. The top two tables cover the capital risk per trade of 1 and 2%, and for comparison we have 10% and 5% on the bottom section. I have also included larger versions of these at the end of the document, so for the purposes of the initial part of this overview, these are all on one page, but if you go to the end of the document, we have actually expanded these into 2-3 pages so that they are easier to review. For example, if we look in the tables at the top of the 2% and 1%, if you were to risk 2% of your account and your goal was to average 3 to 1 on your trades, and all your winners were 35% of all your trades, you would have 0% chance of risk of ruin. As a comparison, going to the 1% table, again, if you average 3 to 1 on your trades, and in this time your win rate is only 30% of your trades, you have 0%. So you have a bit of a spread there between the 2 and the 1%, just as a comparison there. So if you were to err on the side of caution, you could lean on the 1% and actually give yourself an extra 5% of win rate, like a wiggle room to work with. I've just highlighted here on these tables, you can see the cyan and the red, just to give a comparison of where we have 0% risk of ruin. You can see obviously on the 1%, 2% of risk, we have a much wider coverage of cyan 0% in these instances, which goes all the way up to even if you're only 25% correct on a risk reward average of 5 to 1, you can still protect your account and not go into catastrophic loss. Whereas you can see in these lower tables, the cyan coverage is much less, because obviously in risking a larger percent of your account, you need to win and be right more times in order to not go into risk of ruin. So This is just to give you a comparison. For those of you who are already aware of this, just a reminder, but for others who just want to review this in more detail, just to consider this aspect in your trading and the risk reward. In summary, for some of the background that's been provided in this summary document, I just want to touch on some of the main aspects of this, what we consider as a paradigm shift in reflecting on how we can consistently help ourselves to actually make money and protect our account. So in summary again, I've already mentioned anything can happen in the markets. I don't need to know exactly what is going to happen next in order for me to make money. So if you reference the risk reward tables, you can see that your win rate with an average 2 to 1, 3 to 1 can actually really help you to need to be right on every trade. So spend some time going over these tables just to get a sense of the win rate to help you to see that you don't need to be right in every trade in order to make money. We've already covered the edge. You need to have an edge, whatever that is for you, with using the OFA tools, understanding the swing trades with the CWAP and the VWAP, and any other aspects that you use in your order flow trading. And again, every moment in the market is unique. I think you can probably agree that if we look at this column here on mindset in the past, that this typically was our thought process, thinking about how much money I can make on a trade, not sticking to my rules, believing making money is all about finding the perfect entry, and then when it all goes wrong, looking for a reason, someone or something to blame. So in considering this paradigm shift of what we're talking about here with risk to reward, the risk of ruin tables, if we now go to the left column, we can see here now that knowing in advance how much money I can lose on any given trade. Now this can only happen obviously if every trade you're risk sizing, so you know your risk and you know your percentage of capital risk per trade and the risk of ruin in conjunction with your account. Next one, trading your plan with specific rules and your edge. Understanding that making money is about mastering risk and exit management and taking responsibility for every trade that I make and learning from it. So this helps with the risk reward tool. The aim is to have this tool to help keep you in the left side columns so that for every trade you're always anticipating, assessing the risk. Can I afford to take this trade for 1, 2, 3 contracts? Should I be taking this trade? Does it make sense with my rules and my edge? So by keeping focus and always looking to achieve 2, 3 to 1 on all your trades, it keeps you in this left side column. And that's really I would say the main objective and value of this tool is it keeps you engaged and focused with all the dynamic elements of the profile. And you'll see some of the other features that you can adjust. So I just wanted to cover this part of the background here. You can read through this in your own leisure, and some of these are common sense, common knowledge, cutting your losses short, again knowing your risk of ruin probability as referenced in those tables, and catastrophic loss prevention. So you actually know and are very mindful of the percentage you're risking per trade. So that if you do shift into the 5%, 10% bracket, that you are aware of you're putting yourself and your account in more jeopardy by risking that much more. So that in order to recover from any losses, it's going to obviously be tougher on you and on your account to do so. I've mentioned in here just some references to AlgoX. As I alluded to earlier, this has been designed for all users. There's a couple of features here based on compounding, which I have addressed in the document. AlgoX will automatically calculate your number of contracts based on a percentage of your account, and thus it helps with the compounding process, which I've mentioned down here. So I won't spend too much time on this. You can read about this. And so what we'd just like to emphasize here is that we do, in our opinion, we see that risk sizing, it really needs to be your best friend, and really you want it to be a very integral part of your trading plan and daily trading process, helping to keep you stay in the game longer, such that you're grinding your account balance down very slowly if you're making losses, rather than the blow up situation of a few trades with too much risk. One other piece I'd just like to close on here with this section is in utilizing risk reward as part of every trade opportunity. With concentrated effort, you can learn to tolerate uncertainty and ride out the discomfort of drawdowns so as to reach a greater level of success. And in doing so, you can learn to trade focusing on present moment without concern for your emotions or past mistakes. This allows you to take appropriate risk, to balance your risk, and to size your risk and tolerate the uncertainty of the risk. So this is something we all are working towards and would like to work towards in our psychology and our emotions, to remain present in the markets, to be okay taking losses. One of the things with risk reward is that in using it for every trade is you can see right away on a per contract basis how many ticks loss that you will be potentially losing. You're agreeing to lose that amount. And if you reference that to the risk of ruin tables, it gives you a bit more comfort in trading a sensible percentage risk of your account. It just gives you more breathing space to not worry about being right in every trade. Next, I want to cover a summary of the key features and then the key benefits of the risk reward add-on. You can see in this summary on the left here, we have profile entry and stop risk elements based on the core dynamic profile elements. Additionally, for advanced profile users, they will have an expanded list, 6 additional elements, as I covered in the settings video. Dynamic calculation and display of configurable risk-reward entry stop lines with user-selected annotations showing price, ticks, and ratio combinations. So you can see here down here on the chart for oil, which an example of a sell at 1 tick in front of the VWAP, which is the magenta. The risk is 1 tick behind the DWAP, which is the cyan. The projected take profits are set at and showing 2 to 1, 3 to 1, 4 to 1. So you'll see the annotations having price, the number of ticks, and the risk reward ratio. In the volume profile settings, you can configure which of these elements you want to see in any combination. We currently offer up to 9 risk reward ratios. Currently on the chart you're seeing 3, but we do have more projected down depending on the selector in the menu, which I'll show you in a minute. So if I go to the menu now, you can see currently I've set this to 9, and this is again where each of the ratios can be dynamically changed, and these will persist as I covered before in the OFA indicator. So if you want to tweak these to a decimal place for whichever level you want to do, this can be done automatically and dynamically. So currently, as I said, I'm setting and showing 9 values. Just to go through the entry and the stop that I currently have for this example here. So currently the entry is set to the volume weighted average price, which is magenta, and I'm setting it 1, which is 1 tick in front of relative to the current market price of 59.93, 94 now, which can be toggled on and off with this option at the top. This option again is primarily for reviewing historical profiles. So when you're changing the offsets of the entry or the stop, you always know relative to current market price which direction to set the offset. The stop size is set to the DWAP, which is one of these elements at the bottom here, and I've set this to 1 tick behind. If I wanted to adjust this to the 50, which is the dashed white line, you can see that this is automatically recalculated, and now we've gone from having 10 ticks of risk to 6 ticks of risk. So if you consider if you had 2 contracts at 10, which is obviously $200, with 6 ticks of risk here now, by using another one of the profile elements, potentially for slightly less than 2 contract risk, you can now trade 3 contracts and utilize taking one off at 2 to 1 and now one off at 3 to 1 and 4 to 1 based on the updated take profit projections. And you can see now, if I open up the chart, we're going all the way down for all the lines take profits that we want to display. Again, these can be set and adjusted depending on how many. So if you only want to have 6, change that to 6. And that will then persist going forward and is stored as part of the chart until you update this again. The next 2 features here are the minimum maximum risk filters for displaying the lines. These are here, the minimum and the maximum. The next feature is for tracking entry at market, bid or ask, with the stop and take profit lines dynamically adjusting as the market price moves. So you can see here in the entry section we have these 2 options, current bid entry price and the current ask entry price. This is being provided for users who want to perhaps more aggressively or in a scalping situation track the current market price relative and maintaining the risk reward and profit and stop lines whilst the market is moving. So they're updating, so you constantly are aware of your risk reward in that instant. So it's just a a convenience addition that obviously these are not tied to profile elements, but they may be tied to other aspects of a strategy that you use, whereby you can track the current market price, perhaps using it in a market entry situation. Let's just review this profile that we have here, as I specifically selected this to illustrate some of the options we have in terms of where to take our entry and where to place our stop. The premise for this trade, from the 20th close oil session, you can see with the magenta here, this is a strong selling imbalance. That was at the daily high. In the overnight session, you can see that we have a decision point here. The market breaks down. In the London session, you can see within 1 or 2 ticks that this is retested, so it doesn't make any new highs. So we have a retest of this decision point profile here at the point of control. We have 2 attempts to break higher. The market breaks down. So in this instance, I've selected a swing profile to the current bar. Now you can see here there were opportunities at both the CWAP and the VWAP to take an earlier entry. So the market breaks down, but it only breaks by a small number of ticks, and it retraces back. But depending on your trading style, then you can obviously take these earlier entries. But I just want to show by comparison, if I move this back to that area, and either I'm taking 1 tick in front of the VWAP, what I'm going to have to do here in this instance is I'm going to change the minimum risk. So you can see that the minimum risk setting was actually filtering the display of any of these lines. So I'm 1 tick in front of the VWAP, and here I'm 1 tick behind the midline. Now the other potential here is to actually enter at the CWAP. So as you can see here, I've adjusted the entry and the stop size in this instance to being 1 tick behind the VWAP. So we have 5 ticks of risk for this trade, and you can see here the risk projections for this entry and stop. Whilst you can see the projections go all the way down 5 to 1, 6 to 1, the stop would have trailed 1 tick behind the VWAP, and you would actually have been taken out on this bar, which would have then prevented you from actually taking advantage of the rest of this trade. Just wanted to highlight this in terms of how tight your initial risk is and what can actually happen with that, and the benefits of giving it a little bit more breathing space. So if I actually change this back to the midline and go back to our entry, you can see that there's another tick of risk. It's 1 tick behind, and as I move the profile forward, you can see where the midline, which is the dashed white line relative to the VWAP, it has enabled the trade to continue and not be stopped out. Obviously there is a number of options now with the profile and the advanced profile now. I could add, this profile has actually been enabled for advanced profile. If I added the CWAP VWAP difference, which is the green line, we can see also, it's also a tighter area, but it is giving you a little more wiggle room and breathing space. That also is a reminder, is the difference between the VWAP and the CWAP, and it's mirrored on the other side. When you're taking a very tight risk, and in terms of the trailing stop, it can actually be a hindrance in terms of actually getting the full risk reward potential of your trade. For taking a smaller risk, you certainly, yes, get the opportunity to trade more contracts, but you have to then obviously weigh that up with where you're trailing a stop from. So in making this active, you can then attach the order to the entry, and once the entry is filled, you also have the option to attach your stop to the actual risk reward profile stop entry. So once your order has been filled, you can then adjust ATM generated take profit orders to align with the risk reward generated ratio lines that fit your risk profile for this trade. The next thing is the ability to work with past as well as the current live profiles. This will help you to determine what profiles and which profile elements that you want to use in designing and fine-tuning your strategies and trades, and also for AlgoX users to fine-tune again your algos for your execution, management and take profit. In the example I just illustrated there, in doing some analysis on past profiles, you can determine in terms of the contract you're trading, be it oil or ES, for these profile elements, which of these is going to help you to stay in the trade, obviously with the trailing stop, but not taking you out too soon. For AlgoX users who are trading at the edge of the market, with the risk reward projection in your pre-trade planning, you can readily select the best suited and the best fit algos from your already built algos The last couple of pieces here, the tool gives you flexibility with offsets from the entry and stop, and also for the stop we have this option for ticks from entry. Now that's obviously not lined up to any profile element, but it gives you the ability to line up the stop with any other levels that you may use or monitor, then see the risk reward projections. So with risk reward, we can always be asking the question, does this risk reward, is it supported by my trade plan narrative for taking the trade? It also helps break the habits of chasing trades for any unknown or gut feel risk reward. So you can dynamically determine where price needs to be in order to make your minimum 2-to-1, 3-to-1 profit objective, assessing immediately in the market structure if there's any roadblocks, previous highs, double tops, or any areas where you can determine the probability of actually breaking through that, and perhaps ensuring that you're making your 2-to-1 or 3-to-1 before hitting any of these levels.